What if I told you there's a secret signal flashing red right now, a signal that's predicted every major stock market crash in the last 50 years, and nobody, not CNBC, not Bloomberg, not even your financial advisor, is talking about it? Keep watching, because in the next 10 minutes, I'm going to show you exactly what it is and why it could mean the next crash is closer than you think. 1987, 2000, 2008, 2020, 4 massive crashes, trillions wiped out, retirement accounts destroyed, and every single time, this one hidden indicator was screaming sell months in advance. But here's the crazy part. It's not the VIX, it's not the yield curve, it's not even insider selling. It's something way simpler and way scarier. It's called the Buffett Indicator. Yes, named after Warren Buffett, the Oracle of Omaha himself. And in 2001, he called it probably the best single measure of where valuations stand at any given moment. So what is it? It's super simple. Total U.S. stock market value divided by U.S. GDP. In other words, how much are we paying for every dollar the economy actually produces? Let's look at the data. 1929. Before the Great Depression, 120% 1999, dot-com bubble peak, 150% 2007, before the financial crisis, 110% 2021, post-COVID mania, over 200%, an all-time high. And right now, as of October 2025, we're sitting at 195%. That's higher than 2007, higher than 2000, only beaten by the 2021 peak, which, by the way, was followed by a 25% drop in the S&P 500. Think of it like this. GDP equals the size of the real economy. Factories, jobs, sales, taxes. Stocks equals what people are willing to pay for a piece of that pie. When stocks grow faster than the economy, you're in bubble territory. When they grow way faster, you're in please don't touch anything sharp territory. Buffett says under 80% equals stocks are cheap. Buy. 80 to 120% equals fair value, hold. Over 120% equals danger zone. Over 150% equals get the heck out. And we're at 195%. That's not just danger. That's the fire alarm is melting levels. So why isn't this on every headline? 3 reasons. It's boring, no flashy charts, no memes, just math. Wall Street makes money when you buy high. They're not going to tell you to sell. The Fed keeps pumping. Low rates, QE. Don't fight the Fed. It's distorted everything. But here's the thing. The market doesn't care about narratives. It cares about math, and the math is screaming. Let's zoom in on 2025. Corporate debt, highest since 2008. Zombie companies, can't pay interest. 20% of Russell 3000. Margin debt, skyrocketing tech valuations. Nvidia at 40 times sales. Tesla at 15 times. And GDP growth, the Atlanta Fed just downgraded Q4 2025 to 1.2%. Translation, stocks are growing 15% a year, while the economy grows 1%. That gap? Unsustainable. Something's got to give. So what happens when the Buffett indicator finally corrects? Historically, it mean reverts. Hard. From 150% in 2000, dropped to 60% by 2009. That's a 60% stock market crash. If we go from 195% today back to the long-term average of 80%, that's a 60% drop in the total market. S&P 500 from 5,800 to under 2,300. Your 401k cut in half. Tech stocks obliterated. Real estate frozen. But here's the good news. You don't have to panic. You just have to prepare. Here's your 3-step crash survival plan. Step 1, raise cash. Keep 20 to 30% in cash or T-bills. It's earning 4 to 5% now. Not sexy, but safe. Step 2, Own real assets, gold, silver, commodities. They shine when paper burns. Step 3, buy boring dividend stocks. Look for companies with 3+% dividend yield, 10+ years of increases, low debt. Like Coca-Cola, Johnson & Johnson, Procter & Gamble. These survive crashes and pay you while you wait. Want to go full ninja? When the Buffett indicator hits 60 to 70%, that's your all-in signal. That's when Buffett buys. That's when the smart money loads up. And if you're feeling spicy, look into inverse ETFs like SH or SQQQ, but only if you know what you're doing. Full disclosure, I lost $800 on SQQQ in 2021, learned the hard way. Look, I'm not saying the market crashes tomorrow. It could run to 210%, 220%. Who knows? But here's what I'm saying. The higher it goes, the harder it falls. And right now, we're in the highest valuation in human history. This isn't fear-mongering. This is math-mongering. The Buffett indicator doesn't care about AI hype. It doesn't care about election results. It doesn't care about your FOMO. It just reverts. Smash that subscribe